the exit that left no footprints. No alarm sounded. No charts collapsed. Capital didn't rush for the door. And yet, one of the most important exits in the market happened without leaving a trace. To understand why this matters, we need to revisit a phase when prices still held firm and narratives stayed optimistic. Markets appeared resilient. Volatility remained contained. Participation looked healthy. But beneath that appearance, something had already changed. Capital wasn't leaving loudly. It was leaving quietly. The first reveal begins with positioning that looked unchanged on the surface. Large investors still appeared invested. Exposure headlines barely moved. But the nature of that exposure had shifted. Time horizons shortened. Liquidity preferences increased. Positions were structured to unwind quickly without friction or attention. The second reveal appeared in behavior, not data. Trades were broken into smaller pieces. Execution stretched across time. No one wanted to move size visibly. Capital wasn't expressing conviction. It was preserving optionality. The exit had begun, but it was being disguised as participation. The third reveal came through what failed to happen. Rallies no longer attracted new commitment. Gains were met with quiet distribution. Strength became an opportunity to reduce risk invisibly. Nothing reversed sharply, because nothing needed to. Capital was patient. This is how modern exits work. They don't announce themselves. They don't create panic. They don't need urgency. They happen slowly, inside calm conditions, while everyone else believes nothing has changed. By the time the market notices, the footprint is gone, and what follows is never about who sold. It's about who's left. What came next will reveal the cost of an exit no one saw, and why markets feel most fragile after the selling is already over. As the quiet exit continued, the market absorbed it without protest. Prices held. Volatility stayed muted. To most observers, this confirmed resilience. Selling, they assumed, would have shown up in the data. But modern exits don't announce themselves through price alone. The conflict emerged in participation. Volume remained steady, yet its character changed. Fewer trades carried conviction. More trades existed to manage exposure. Capital flowed to the market without anchoring it. Activity stayed high, but commitment thinned. Liquidity masked the process effectively. Depth was visible. Spread stayed tight. Execution looked orderly. But beneath that order was a subtle imbalance. More capital wanted flexibility than permanence. The market still had buyers, but fewer holders. Institutional desks felt the shift first. Rallies required more effort to extend. Strength stalled sooner. Breakouts failed quietly, not because sellers overwhelmed demand, but because demand no longer wanted to commit. The exit had removed the marginal buyer without making noise. The tension deepened as this behavior repeated. Each recovery was met with distribution. Each calm session provided cover for further reduction. Capital didn't rush. It blended in. The exit left no fingerprints because it used patience instead of urgency. Derivatives markets confirmed the change subtly. Protection stayed bid even as volatility remained low. Skew refused to normalize. Traders weren't hedging fear. They were hedging absence. The risk wasn't collapse. It was what would happen once the quiet exit finished. The buildup accelerated when correlations tightened. Assets that normally offset each other moved together. Diversification weakened. As holders quietly disappeared, the market's internal balance grew more fragile. Even though nothing looked broken, veteran participants recognized the warning clearly. Markets don't weaken when selling is loud. They weaken when selling is invisible, because invisible exits remove resilience without triggering response. By the time the exit neared completion, the market still looked healthy, but it was lighter, less committed, less defended, less forgiving. The quiet exit had done its work, and what followed would reveal what happens when pressure arrives after the sellers are already gone, and belief is asked to hold the market up alone. That pressure arrived in a form almost too ordinary to notice. A mild shift in expectations. A routine reassessment of outlook. Nothing that should have mattered on its own, but the market responded differently than it would have before. Prices slipped and didn't recover. Buyers appeared, but they lacked persistence. Bids showed up briefly, then faded. The market tested support and found it then. Not absent, but fragile. The quiet exit had already removed the participants who once absorbed uncertainty without hesitation. The conflict intensified as this weakness repeated. Each small decline traveled further than expected. Recovery stalled earlier. What once felt like noise now felt directional. The market wasn't reacting to new information. It was reacting to missing participation. Liquidity exposed the truth quickly. Depth existed, but it withdrew under pressure. Capital no longer leaned into uncertainty. It waited for resolution. Support arrived late, after levels were breached. The system had become reactive because the stabilizers were already gone. Institutional systems responded in predictable ways. Algorithms reduced aggressiveness. Risk controls trimmed exposure. These responses were orderly and rational, and they removed even more support. What remained was a market trying to function without the capital that once gave it confidence. The buildup accelerated as correlations tightened sharply. Assets that usually moved independently began falling together. Diversification thinned. With fewer committed holders, everything became more sensitive to pressure. Small moves grew heavier simply because fewer participants were willing to counter them. Veteran traders recognized the pattern immediately. This wasn't the start of a sell-off. It was the aftershock of one that had already happened quietly. The exit had removed belief before it removed price, and now price was catching up. Support levels failed without drama, not because sellers overwhelmed them, but because buyers no longer felt obligated to defend them. The market adjusted lower in stages, each one confirming how much resilience had already been drained. That realization was unsettling. The most important selling had already occurred. It just hadn't left footprints. The final phase would show what happens after an invisible exit finishes, when the market is forced to find a new balance without the participants it once relied on, and why recovery, when it comes, never looks the same afterward. The adjustment that followed felt restrained, almost respectful. Prices didn't collapse. They settled. The market searched for balance in an environment that no longer had the same participants holding it steady. What remained wasn't panic. It was exposure. That was the climax. Not a sudden fall, but a moment of recognition. The market realized it had been standing on capital that had already left. The quiet exit had removed resilience first, then waited patiently for reality to notice. When pressure arrived, there was no one left to argue with it. Liquidity returned selectively, but with conditions. Capital stepped in only after direction was clear. Support appeared lower, firmer, and far less generous than before. The market wasn't broken. It was lighter, and lighter markets moved differently under stress. As volatility normalized, the resolution unfolded slowly. New holders emerged, but they were cautious. Time horizons shortened. Conviction had to be rebuilt, not assumed. The market stabilized again, but the character of that stability had changed. It was earned, not inherited. What lingered was the lesson most people miss. Markets don't become fragile when selling is loud. They become fragile when selling is finished. When the exits are complete and belief is asked to do the work alone. The invisible exit left no footprints, but it changed everything. It explained why support felt unreliable, why recovery struggled, why small shocks travel further than they should. The damage wasn't done in the moment of decline. It was done earlier, quietly, while calm provided cover. Understanding this reframes how strength should be judged, not by how well markets hold up during calm, but by who is still willing to hold them up when calm ends. Because by the time exits become visible, they are already irrelevant. The real question is always this: who has already left, and who still believes they are standing on solid ground. Sometimes the smallest shift in perspective becomes the beginning of a new future. The